I came across this article in Seeking Alpha titled How to Build a $100,000 Dividend Portfolio with 2 ETFs and 5 individual picks. This is a really interesting article because it talks about what I talk about on my channel all the time, where I talk about the core and satellite approach to investing and building a dividend portfolio that you're one day going to live off of. This article from Frederick Mueller is really good, and it touches on what I talk about on my channel, but it explains it in a different way. So if you're used to my channel where I talk about SHD, DGRO as a simple path to wealth with dividend investing, which was inspired by J.L. Collins, I talk a lot about that and building a dividend portfolio using the core and satellite approach. What Frederick is talking about in this article is very similar, but he phrases it and explains it in a different way. And I think if you're used to my channel and you enjoy learning about the core and satellite approach to investing, I think you're going to really enjoy this article. And if this is one of the very first videos that you're watching here, this is a new series that I created on my channel. I've been creating YouTube videos for about 5 years. I still upload regularly on Sunday like I always do, but this is part of a new series that I'm doing where every single Thursday I'm reviewing an article and discussing it with all of you. So the article starts off with a summary, and the summary is building a dividend income-oriented investment portfolio requires carefully selecting each of its components. Doing so ensures reduced risk level, thereby elevating the likelihood of positive investment outcomes. It's important that each component does not account for a disproportionately high percentage of the overall portfolio, allowing you to invest with a reduced company-specific and sector-specific concentration risk. He doesn't mention this in the article, but what's also important is you don't want to disproportionately have one single stock represent more than a disproportionate amount of your income. I'll give you an example. If you have maybe a SIN stock that is yielding 8 or 9%, if you invest $10,000 into that, you're going to have significantly more income than if you were maybe to invest into a Home Depot or a Lowe's. And so you don't want to have so much concentration in just one individual investment and skew your income just so heavily into one or two stocks. So he doesn't mention that in this article, but I think that's important to point out that when you're thinking about building a dividend portfolio, it's not just the amount that you have allocated to an individual stock, but where's your income coming from? And so that's something to consider. It's not necessarily a deal breaker, but something to keep on your mind. He continues writing here that in this article, I will demonstrate how you could allocate the amount of $100,000 among 2 ETFs and 5 companies with attractive risk-reward profiles. So let's take a look at what he has here. So his investment thesis is the selection of ETFs and individual companies and the strategic allocation of your dividend portfolio is what most determine the long-term success of your investment portfolio. So the strategic allocation. Okay. To achieve successful investment results over the long term, several components are important when constructing dividend income-oriented investment portfolios. First, when constructing a dividend portfolio from zero, it is important that each company does not exceed 5% of the overall portfolio. Now, guys, where have you heard that before? Have you followed the channel and you've heard me say that before? Does not exceed 5% of the overall portfolio. That's not the reason why I picked this article, but yeah, that's a pretty big point. Thus ensuring a reduced company-specific allocation risk. Such a strategy means that the performance of any single company will only have a limited impact on the portfolio's total return. This is crucial as it will minimize the effect of a company's poor performance on the overall portfolio during any given period. So you're not going to have that boom or bust when you have a company that's, when you're limiting how much you're investing into an individual stock. Okay. Second, he writes here, I believe it is important that the portfolio offers investors reduced overall risk level, which leads to an enhanced probability of successful investment outcomes. This reduced risk level, for example, can be reached through the inclusion of companies with low beta factors in addition to a broad diversification across companies and sectors. So a couple of things here that I want to highlight. When he's talking about beta factors, he's talking about volatility. And if you're not familiar with beta, or you maybe have heard of it, what beta is measured on a scale of if a company has a beta of 1, it means that it tracks the market. So the S&P 500 has a beta of 1. That is the market. If a stock or an ETF has a higher beta than 1, that means it is inherently more volatile than the overall market. And if a company has a lower beta than 1, say for example it has 0.63 as an example, well then it has a lower beta and lower volatility than the overall market. So you're going to have lower lows and lower highs in terms of the price fluctuation. So that's what he's talking about when it comes to beta. Touching on the broad diversification, when you invest into 2 ETFs, you're going to immediately get diversification than if you were to invest into, 30 or 40 individual stocks. So those two factors, low beta and diversification, are really, really important. So moving on, third, for long-term investment success, I believe it is crucial that the portfolio successfully blends dividend income and dividend growth, allowing you not only to generate income for today, but also for tomorrow. So important, especially when you consider inflation and the rising cost of everything. Fourth, I believe it is crucial that the individually selected companies are attractive when it comes to risk and reward, thereby providing investors with a high likelihood of attractive investment results. The dividend portfolio I'm presenting in today's article fulfills all of these criteria. No individual company accounts for more than 4.5% of the overall portfolio, indicating a reduced company-specific concentration risk. The reduced sector-specific concentration risk is evidenced by the fact that no sector accounts for more than 18% of the overall portfolio. In addition, it can be highlighted that the portfolio successfully combines dividend income and dividend growth, evidenced by the weighted average dividend yield trailing of 3.59% and a 5-year weighted average dividend growth rate of 7.58%. That is really, really good. This is so important, guys. A lot of you watching my channel are maybe newer to investing, or you're new to the FIRE movement, or new to building out your dividend portfolio. If you're looking on your screen here and you see that I highlighted weighted average, when I was first building out my portfolio, I was kind of a noob. I overlooked the fact that every time when you're building a portfolio, you have to keep in mind the weighted average dividend yield and dividend growth rate. I really stress that now because in the beginning, when I first started putting together my portfolio, it was kind of like, Pokemon cards. I was trying to collect them all, and, it was just not very efficient. I wish 10 years ago, somebody would have taken me by the hand and, kind of sat me down and said, hey, Jake, you need to look at this in a different way. And the way that you look at it is through weighted averages. And what you're trying to accomplish is you're trying to solve for what dividend yield do you want, that is weighted average for your portfolio, and what is the weighted average dividend growth that you're looking for. And it's just an equation. What dividend yield do you need, and how quickly should that dividend yield be growing? It's kind of like the dividend snowball effect, right? How quickly is it going to grow and compound? But it's so important, guys, that if you're new to dividend investing, you're trying to build a dividend portfolio, this is different than just the traditional FIRE movement where you're investing everything into VTI or the total US stock market. You want to really look at this, and this should be in focus when you're building a dividend portfolio. I'm taking the time to stress this because it is so important, especially if you're new. It's easy to overlook this. So moving on with the article, I have selected the following individual companies for this dividend portfolio. First, MasterCard. Second, Realty Income. Third, RS Capital. Fourth, Vici Properties. And fifth, Apple. Okay, so there's a few REITs in here, so this is not going to necessarily be the most tax efficient. So ideally, you would want to have this in a tax advantaged account. So first, MasterCard has predominantly been selected for this dividend portfolio, given its capacity to provide investors with dividend growth. The company's 10-year dividend growth rate stands at 22%. It's significant competitive advantages and growth prospects. I have just selected the company as one of my top 2 dividend growth companies to consider investing in during the month of June. In particular, Realty Income has been selected due to its attractive risk-reward profile and ability to mix dividend income and dividend growth. The company's dividend yield trailing stands at 5.94%, and its 5-year dividend growth rate at 3.55%, effectively combining dividend income and dividend growth. RS Capital has predominantly been chosen for its capacity to produce income. The company's dividend yield trailing stands at 8.96%. It is further worth noting that it has produced 19 consecutive years of dividend payments. Next is Vici Properties, and it has been selected given its attractive valuation, the mix of dividend income and dividend growth. The company exhibits a dividend yield trailing of 5.83% and a 5-year dividend growth rate CAGR of 7.76%. Vici's Properties price by adjusted funds from operation forward-looking stands at 12.76%. 13.12% below the sector median. So what he's saying here, it's very fairly valued given the sector mean, I guess. So it is further worth highlighting that Vici Properties has just been selected as one of my top high dividend yield companies to consider investing in during the month of June. And then the last one, Apple, the US technology giant, has been selected due to its enormous financial health, competitive advantages, positive growth outlook, and the attractive risk-reward profile. My confidence in Apple is reflected in the fact that the company from Cupertino continues to represent the largest proportion of my personal investment portfolio. The following ETFs have been selected for this dividend portfolio. The first is SCHD and the second HDV. I've selected SCHD for its superior mix of dividend income and dividend growth, as well as its strong focus on companies that pay sustainable dividends. The next is HDV. It's been chosen thanks to its dividend yield, its trailing of 3.35%, its low expense ratio of 0.08%, which is significantly below the median of all ETFs of 0.48%, and its low annualized volatility of 10.4%, which is below the median of all ETFs 10.72%. Now, I'm not sure why he would say all ETFs. That's like comparing an apple and a watermelon. Like, yeah, all fruits weigh 7.394 ounces on average, but like, is that really a good comparison? Is he talking about dividend ETFs? That's a little bit weird. I don't know why he added that into the article here, but okay, that's cool. And the expenses of 0.48% is the average for ETFs. Yeah, there's a lot of expensive ETFs out there. You really want to be careful on the expense ratio. So the overview of the 2 selected ETFs and 5 individual picks. You can pause the video here and you can take a look at them if you want to see them in detail. But yeah, there you have it. SHD, HDV, Apple, MasterCard, Realty Income, RS Capital, and Vici Properties. So risk analysis of the current composition of this dividend portfolio, the risk analysis of the portfolio allocation per company ETF. So the next part of this article is more focused on the risk aspect or the beta side of things, right? So who he's addressing in most cases is someone who's maybe a little bit closer to retirement. And when you're in retirement, you don't want volatility. And if you've ever spoken to a financial advisor, oftentimes half of the conversation will just be about how do you reduce your risk and your exposure to risk and how do you diversify. And so if you've never spoken to a financial advisor, this is kind of how the conversation goes a little bit. So just humor me here. It's a little bit nerdy. It's talking about risks and all that good stuff. So just understand, if you want to level up your game when it comes to building your own portfolio, it's important that you understand how to think about this. And just having surface level information is probably enough for most people. So he continues writing here, the 2 selected ETFs, SHD and HDV, account for the largest portion of this dividend portfolio, each accounting for 40%, ensuring an extensive portfolio diversification across companies. I like that, by the way. I like that it's the core and satellite. He's doing the core and satellite without even calling it the core and satellite. Each of the individually selected companies, Apple, Realty Income, Vici Properties, RS Capital, and MasterCard, account for 4% of the overall portfolio, ensuring a reduced specific concentration risk. And as you can see here, each individual stock represents 4%, and then 40% HDV, 40% SCHD. Now, me personally, I like SCHD and DGRO, and I would skew a little bit more. Instead of going like with an Apple or a MasterCard with very, very low yields, I'd probably skew with a higher yield in my satellite positions, right? The individual stocks in this case are the satellite positions. But, I mentioned at the beginning of the video, he's explaining what I talk about, but in a different way and from a different lens. And so it's interesting to see someone else's opinion on this. So moving on, the risk analysis of the company-specific concentration risk when allocating SHD and HDV across the companies they are invested in. So the graphic below illustrates the companies that represent the largest proportion of this dividend portfolio when allocating each of these ETFs, both SHD and HDV, across the companies that they are invested in. This is actually a really interesting way to look at this, by the way. I've never done this because it's a little bit time intensive and the ETFs adjust every year. The allocation changes. So that's why I really haven't done it. But it's interesting to see how what he did was he took all of the holdings in HDV, SHD, proportionately weighted them and included his individual picks, and he allocated how they represent, like what he's actually invested in. And that's an interesting way. What it does is it really makes it tangible that, hey, when you invest into an ETF, this is actually what you're investing in, and he stack ranks them. It's actually a cool exercise. I wonder if there's like a website or something that could help you do that so you don't have to do it manually. I don't know how you would do that otherwise without making it entirely manual. But it wouldn't take that long. I wouldn't assume. It depends on how many ETFs you have. But anyways, continuing on, it is worth highlighting that Chevron constitutes the largest proportion, even though the company has not been selected directly for this dividend portfolio. Nevertheless, both SHD and HDV are invested in Chevron. The company accounts for 4.27% of the overall portfolio. In second, third, fourth, and fifth, and sixth place are Vici Properties, Realty Income, MasterCard, RS Capital, and Apple with 4% each. Each of these companies have been selected individually to be part of this portfolio. It is further worth highlighting that they are not part of the two selected ETFs. So this is really a good thing to highlight here. This is why you have satellite positions, so that you can balance out either for more growth or for more yield, because all of these individual stocks are not represented in those two ETFs. So it's a good way to broaden out, get more diversification depending on, where you're at in life, if you need more yield or you need more growth. All remaining companies that have not been individually selected, but at least one of the ETFs, SHD or HDV, is invested in them. The seven largest position in this portfolio is Verizon with 3.84% of the portfolio, followed by AbbVie at 3.38%, ExxonMobil with 3.32, and PepsiCo with 3.28. The portfolio's reduced risk level and increased likelihood of positive investment outcomes are evidenced by no single company accounting for more than 4.5% of the overall portfolio. Additionally, each position representing at least 4% of the portfolio has a particularly attractive risk-reward profile. So what's interesting is he took what I say to a whole nother level. Now he's saying with your ETFs and your individual holdings, nothing can represent more than 5%. That's a little bit extreme. It's taken to a whole nother level. Like, for example, I invest into VGT in my Roth IRA. It's one of my larger holdings, VGT. And like the bulk of it is like Apple, Microsoft, Nvidia, like stuff like that. And so, but it's market cap weighted, right? As they go down in value and go up in value, they'll represent a higher allocation in the ETF. But that's interesting that he's approaching that even with the ETF. In my opinion, not to bash him at all, but I think that's a little excessive. I don't think you have to do that. Okay. So, if you want to be a little bit fanatic about it, crazy about it, I guess you could do it. But I don't think for 99.9% of people watching, that's going to be necessary. So risk analysis of the portfolio's sector-specific concentration risk when distributing SHD and HDV across their sectors. Representing 17.74% of the overall portfolio, the financial sector accounts for the largest proportion, followed by the energy sector with 15.31%, the consumer staples sector with 13.65%, the healthcare sector at 12.65%, and information technology with 11.28%. The remaining sectors account for less than 10% of the overall portfolio, while real estate sector makes up 8%, the industrial sector just over 6%, the communication sector at 5%, the consumer discretionary sector at 4.5%, and the utility sector just under 4%, and the materials sector at just under 2%. So yeah, it's he's just kind of like the individual holdings mapping out the individual sector weighting. And the fact that no sector accounts for more than 18% of the overall portfolio is an indicator of the portfolio's extensive diversification across sectors, indicating a reduced sector-specific allocation risk. Risk analysis, analyzing the 5 individual positions of the dividend portfolio, analysis of the dividend yield trailing and the dividend growth rate CAGR of the 5 individual positions. The chart below highlights that each of the individually selected companies in this dividend portfolio blend dividend income and dividend growth, thus indicating their suitability for dividend income oriented investors. And you can see here on the little chart, I can't click on the chart here, but you can see the individual positions and their yield and their dividend growth rate over the last 5 years. With a 5-year dividend growth rate of 16.22%, MasterCard is one that contributes the most to the portfolio's dividend growth potential. With a dividend yield of 8.96%, RS Capital is the company that contributes the most to the production of the dividend income. This is kind of what I was talking about earlier, right? Where if you have one stock that, greatly outweighs how much income you're getting, you take on a little bit more risk. He doesn't highlight that here in the article, but that is definitely something to consider. With a dividend yield and a 5-year dividend growth rate of 5.94% and 3.55% respectively, so dividend yield of just under 6 and a 5-year dividend CAGR of 3.5%, Realty Income effectively blends dividend income and dividend growth. The same is true for Vici Properties that exhibits a dividend yield of just under 6% while exhibiting a 5-year dividend growth rate of just under 8%. At first glance, Apple may not seem particularly attractive for this portfolio with a dividend yield of just 0.5% and a 5-year dividend growth rate of 5.5%. However, I consider the company an excellent choice to optimize the portfolio's risk-reward profile. So this is what he's talking about with the beta. Analysis of the 24-month and the 60-month beta factors of the 5 individual positions of this dividend portfolio. The analysis of the 24-month and 60-month beta factors. So once again, so the 24-month is the 2-year and the 60-month. This is how the beta, right? Remember, if the beta is 1, it's market average. If the beta is above 1, it's more volatile. If the beta is below 1, it's less volatile. 3 of the 5 individually selected companies showcase a 24-month beta factor below 1. Realty Income exhibits a 24-month beta factor of 0.67, and RS Capital stands at 0.69, and Vici at 0.82. These numbers indicate that each pick contributes to reducing the volatility of this dividend portfolio. Only 2, Apple and MasterCard, have a 24-month beta factor above 1. Apple's 24-month beta factor stands at 1.15 and MasterCard's 1.04. Now, I'm a little bit confused. Didn't he say the reason why he has Apple is to reduce the risk reward, but then he's including it with a higher beta? I think he just likes Apple and he needed a technology company. And so he picked Apple. I mean, if you're a financial advisor and you're working on behalf of somebody, I guess you could do that. But I think your average person, I wouldn't think about it that way. I don't know. To each their own, I guess. But for me, I think that's a little bit overboard. I wouldn't map it out so strictly. I don't know. Anyways, that's just my opinion. The analysis of the payout ratio and the EPS diluted growth rates of the 5 individual positions of this dividend portfolio. When analyzing the payout ratios and the EPS diluted growth rates forward of the 5 individually selected companies, it can be highlighted the portfolio's reduced risk level in addition to the enormous potential for dividend growth. With a payout ratio of 19% and EPS diluted growth rate of just under 16%, MasterCard provides investors with strong potential for dividend growth. The same is true for Vici Properties, which showcases a payout ratio of 66% and an EPS diluted growth rate. Vici's is a REIT. You don't use the payout ratio. Maybe he used the price by adjusted funds from operations, but this is a mistake if he did this. And I don't know what the payout ratio you don't use payout ratio for REITs. But anyways, that's very, very important, guys, because you'll look at the payout ratio on some of these REITs and it's like 200. What you do is you use the price by the FFO, funds from operations, or price by adjusted funds from operations. So this is a mistake. It is further worth highlighting that I do not see realty income and RS Capital elevated payout ratios. The payout ratios don't matter. I'm not even going to read this because this is wrong. Don't use payout ratio for REITs. The additional advantages of the dividend income accelerated portfolio in comparison to this dividend portfolio. So the portfolio that I presented in today's article provides investors with a weighted average dividend yield trailing of 3.5%. And with a weighted average dividend growth rate of 7.5%. Now, this kind of goes back to what I was saying earlier. You really, really want to use the weighted average, and you really want to calculate this because this is what's so important. This indicates that it effectively blends dividend income and with potential for dividend growth. In comparison to the portfolio presented in today's article, it can be highlighted that the dividend income accelerated portfolio showcases even superior metrics. So I guess this is another portfolio that he wrote on Seeking Alpha. So I don't have reference to that, but okay. So considering the portfolio's current composition, the dividend income accelerated portfolio offers investors a weighted average dividend yield of 4.5% in combination with a 5-year dividend CAGR of 8%, demonstrating superior results when it comes to dividend income and dividend growth. Moreover, I'm convinced that the dividend income accelerated portfolio provides investors with an even lower risk level compared to the portfolio presented in this article. This is due to an extensive diversification across sectors and industries and its inclusion of financially healthy companies with strong competitive advantages. So this is my only critique with this article is it's like YouTube. You create a video and you don't have all the information and then say, all right, if you want the full story, you have to now go watch this other video. I wish he would have highlighted the key points of this, because if you're making a comparison, just give me the highlights. Don't make me go read another article. Okay, that's whatever. I don't know. Maybe I'm being too I don't know. That's just how I see it. Anyways, conclusion, the portfolio presented in today's article does not only provides investors with a reduced risk level through its inclusion of financially healthy companies with low beta factors, but also effectively blends dividend income and potential for dividend growth. This is evidenced by the portfolio's weighted average dividend yield of 3.5% and its 5-year weighted average dividend growth rate of 7.5%. I consider this portfolio to be a solid choice for dividend income investors that are aiming to invest with a reduced level of risk. This is what it really comes down to, guys. This is the key thing. How to lower your risk and things to consider when you want to lower your risk. Sector diversification, individual stock diversification, beta diversification, all of the growth and yield diversification, all those good things. So he's really leading you in the right direction. This is all valuable information. And then lastly, nevertheless, I believe that the current composition of the dividend income accelerator portfolio, this famous portfolio that we didn't really get to see, not only offers investors a superior mix of dividend income and dividend growth. The portfolio has a weighted average dividend yield of 4.5% and a 5-year weighted average dividend yield of 8%. Who gives it? I don't care. I don't see it in the article. So but it also provides a superior risk-reward profile, offering investors an increased likelihood of I give the article, because of that, I give the article like a B-, like out of, a B-, because people don't care about this other accelerator portfolio. They care about this article. So Frederick, if you're watching the video, don't reference and highlight your conclusion from a different article. That's like me making a video, referencing another video, not highlighting anything about the video, but saying the other video was better. Like, WTF? Oh, man. Anyways, so B- on the article, in terms of the information provided, in terms of how to think about this in a different way, I think it was very, very valuable. Now, let's go and take a look at some comments here. So to generate $100K per year in dividend income, you'll need 2.8 million roughly. How many folks have that much saved? Not many. So the article, if you want 100,000 a year, you take the 100,000 and you times it by what the yield would be. If you have a 3.59% yield, not many people are going to have that. In the defense here of, from Frederick, the portfolio discussed in this article targets a $100,000 investment. So he's not talking about generating $100,000, in this article, this specific article. It's just talking about building a $100,000 dividend portfolio. So this portfolio would generate $3,590 with the numbers that he provided. Okay, and the number, whether you have a $100,000 portfolio or a $500,000 portfolio, that doesn't really matter as much. What matters is, well, how much income do you need? What are your expenses? If you have $100,000 in expenses, well, yeah, you're probably not going to retire if you don't have anything saved. You're probably going to work a long time. Well, not many people, now this is kind of let me play devil's advocate here. Not very many people live below their means. Not many people don't, buy that new car or go into debt because they see their neighbor do it. Now, some people obviously are less fortunate and are not in the position. Now, I'm not talking about those people, but what I'm saying is like, what you don't want to do, and I see this all the time, is don't compare yourself to other people. When you see an article like this, don't think that, it's easy to everybody kind of wants to see how they compare. Are they normal? Are they not normal? But just understanding, you probably have picked that up on my videos. When I create videos and I talk about a dollar amount, I always say that it's relative. Somebody in New York has much higher expenses than I have where I live. And some people have big boats and they do big things and go on vacations and all that good stuff. You don't want to compare yourself. It just is going to make you unhappy. And that's why I've pretty much deleted all social media except for Instagram. I'm addicted to memes. Cat memes in particular, but you just don't want to compare yourself. It's not healthy. It's not good. Yeah. Anyways, another comment here. Apple as part of a diversified focused portfolio makes 0 sense. It makes sense in any investment portfolio. It makes sense in any investment portfolio for the sake of owning it, but really not for the dividend. Now, I have to agree with this guy. The dividend yield of 0.5%, having Apple in the portfolio, you're not doing it for the income. In my opinion, you're better off just investing in the S&P 500, which is also not for just the income. And you have more single stock risk. In my opinion, it doesn't make a lot of sense to invest into Apple for the dividend. It's more, and you have to understand this, guys, it's more for the emotional buy. You're investing into Apple because you like their products. You're a consumer of them. It's an emotional buy. It's really, really hard to live off of the income from Apple. Like, who I could see investing into Apple? Maybe you have a child. You just had a son or a daughter and you want to buy them a stock. Well, yeah, you could buy them as a gift, as a birthday present each year. You could buy them $100 worth of Apple stock and let it grow for the next 20, 30, 40 years for your son or your daughter. Absolutely, that could make sense. But for everybody else who's nearing retirement and maybe doesn't have a lot of money to invest, I don't see, me personally, I would much prefer, like when I think about it, let me invite you to how I think about this. I'm going to invite you into my brain and my train of thought for this. I think about, if I had $10,000, would I rather invest it into Apple or would I rather invest it into DGRO? It's like a no-brainer. I would much rather just throw the $10,000 into DGRO. There's no single stock risk. I'm getting better dividend growth. I'm getting a 4 or 5 times higher starting dividend yield. It's a no-brainer, in my opinion. Now, maybe somebody's in a different situation, and that's why you have to understand what situation you're in. But that's how I view it, okay? And same thing for any other stock. Like if I'm thinking about, should I buy this stock? Or do I just buy SHD? Or do I just buy DGRO? Now, if I want it for a satellite position, that's a little bit different, okay? But if you're ever on the fence, do I want this? Do I not want this? Don't make life complicated. Just throw it into SHD. I don't know, DGRO. But that's how I think about it. Another comment here is, in general, I like it, but how can Apple possibly be part of a dividend portfolio? Sure, it can be part of a diversified portfolio, but if you're designing a dividend portfolio, you would want something with an actual yield. I'm not trying to take shots fired at Apple, but yeah, if you're a dividend investor, you want to invest into stocks that pay a dividend or growing their dividend, and not just for if you want a lower beta or lower risk, once again, would you achieve that more from an ETF or a single stock? So you have to be the decider of that. Everyone has to make their own decisions. And the reason why I love creating these videos and having this conversation and this open open-ish dialogue with all of you to kind of get your brains working to how to think about this, right? Does this make sense, or does something else make sense? I like reading contrarian opinions on, how people, like, for example, I love reading the dividend irrelevance theory and all those people that bash dividend investing. I love seeing the other side of things so that I can make my own informed decision and be comfortable and confident that I'm seeing both sides and I'm making the right decision for me in my particular situation. So all in all, once again, the article, I give it a B- in terms of the because of that, what he did with referencing another portfolio that he doesn't even talk about in the article. Come on, dude, you can't do that. But the way, how he talks about, reducing your risk by looking at your sector allocation, your individual stock allocation, your beta, all of those good things. And if you're looking to build a dividend portfolio, there's a lot of valuable information in here. It really, it kind of confirms what I've been talking about forever when it comes to the simple path to wealth with dividend investing using the core and satellite approach. For me, the simple path to wealth, invest into SHD, invest into DJRO. That makes up the bulk of your portfolio, 60 to 80% of your overall portfolio. And then if you need a higher yield or a higher dividend growth rate, you then add satellite positions that will contribute towards your goals. That's how it works, guys. But yeah, I hope that the video was helpful. I hope that you learned something new. And as always, everybody, I'll be back on Sunday. And going forward, as always, I will be back next Thursday. I'll see you, everybody. Thanks for watching.